Thank you, Commissioner Altmaier, for your welcoming remarks. As noted, we have a very full agenda over the next 2 days for the NAIC's flagship international event. We're glad that you're here, even if it is virtually. A couple of housekeeping remarks before we move into our first session. First of all, for all of our live panels, we encourage you to submit a question, and we've reserved 10 minutes at the end of each panel for your questions. We will try to answer as many of them as possible. You can submit your questions from the event app. Click the Ask a Question button on the left-hand menu. Secondly, an updated schedule, as well as all of our panelists' bios, can be found in the event app. Without further ado, let's move on to our first panel. Across the Atlantic, European Perspectives on Key 2021 Priorities. This panel is moderated by Commissioner Doug Omen of the Iowa Insurance Division. Joining him on this panel is Anna Sweeney, Executive Director in Insurance for the Bank of England Prudential Regulation Authority and Chair of the Sustainable Insurance Forum. Frank Grund, Chief Executive Director of Insurance and Pension Fund Supervision for the Federal Financial Supervisory Authority, BaFin, and Birgit Rüteshauser, Head of the Insurance Division for the Swiss Financial Market Supervisory Authority, FINMA. Commissioner, over to you.
Thank you, Akram. Welcome to the panel Across the Atlantic, European Perspectives on Key 2021 Priorities. From a global perspective, the year of 2021 is turning out to be pivotal. The COVID-19 pandemic has accelerated a global digital transformation, which has led to enhanced opportunities, but also challenges for policyholders, insurers, and regulators. Here in the United States, we are addressing many strategic regulatory priorities: consumer data privacy protections, issues surrounding big data and the use of artificial intelligence, and climate and resilience. Panelists on today's panel will discuss European regulatory priorities. The discussion will include emerging issues on digitalization, operational resilience, AI, and sustainability. We will also explore their views relating to the ongoing Solvency II review and the evolving relationship between the EU and the UK following Brexit. We will have an opportunity for a Q&A at the end of the session. Please submit your questions throughout the session using the Q&A function on the left side of your screen called Ask a Question. I should also add that all panelists' bios are online. We want to allow as much time as possible for discussion, so please refer to the forum website to learn more about our panelists. So without further ado, let me welcome Anna, Frank, and Birgit to our panel, and let's start with 3 questions to open our discussion. The first question is, what do you believe are the most pressing challenges and opportunities for European regulators in the coming years? What are your regulatory strategies and priorities in these areas? And third, where are you optimistic? We'll start with Frank, then go to Anna, and then to Birgit. So Frank.
Yeah, first of all, congratulations to 150 years NAIC. I think you can be proud of long history, and I send you my best wishes for the next 150 years, and I'm very happy to be part of this international panel. Your question, Doug, where are you optimistic? More or less, I'm always optimistic because we had a real stress test in 2020, and we saw that insurance industry was able to manage the stress test. And so far, I'm optimistic. But COVID is obviously still on our agenda. The crisis is not over yet. We don't know yet how real economy will manage and come out of that. So that is one of our strategic priorities. For us, especially in Germany, with a very low interest rate, we can say negative interest rate we are facing still. It's the number 2 on our agenda, how especially the life insurance sector will manage the low interest rate. And Besides these two topics, COVID and low interest rate, I think it's obvious that addressing climate change is one of our strategic priorities. We at BaFin in Germany try to engage intensely with our sector to understand the exposures, what is already done, how is the risk management working, and we try to communicate expectations. We are recently doing a survey, and we expect insurers to use forward-looking tools, also quantitative calculations to assess their exposure in regard of climate change. I will stop here. Thank you.
Anna?
Thanks, Doug. I'm pleased to report that while we may have left Europe, the European Union in the UK, my answer is actually really similarly aligned with Frank's, which I am very pleased about. So I think while we agree that the insurance industry, certainly the parts of it that we see in the UK, has coped resiliently with both the operational and the financial impact of COVID. We're not out of the woods, and it may be that there are some credit hits that are still to come, and longer term impacts both on the sectors that the industry supports and invests in, but also from the operational impacts of the changed working from home that is likely to become some version of the new normal. So all of those things are very squarely on our radar. And the impact of low interest rates and what that's driven different parts of the industry to has been sort of our biggest priority pre-COVID for a number of years, and it leads to a range of different impacts. So we've seen some conduct issues in the UK personal lines sector that have been driven by that reduction in investment income, and that has led to increased competition and some unhealthy behaviours, which have had to see regulatory intervention. And on the life insurance side, that search for yield is also driving some interesting behaviour. So we've seen, for example, concentration of investments where the sort of the marginal benefit and perhaps some marginal regulatory benefits might be gained, which is leaving some balance sheets overly exposed and overly concentrated, and therefore has needed regulatory intervention. I think that the need for Build Back Better and the prioritization that governments around the world are understandably putting on that, allied with the role that the investments of the sector can play in the green agenda, I think also put some pressure on regulators for how to accommodate those kind of investments in a balanced and measured way, which recognises the value that the industry can give to the economy, but ensures that we're protecting consumers and policyholders, in particular long-term policyholders, appropriately. I think is another big issue. And then climate is a big issue for us right across the Bank of England, and we are later this year running a stress test, a parallel stress test across both the insurance sector and the banking sector, looking at trying to size the impact of different scenarios of climate change, and both size it for individual firms, size it across different parts of the sector, but also look to see interconnections between banks and insurers. For example, where insurers might withdraw cover in flood-exposed areas, what does that mean for lending in those areas? So that's a sort of a new piece of our strategy, as you asked. We're very excited about it, but obviously it's going to take a lot of effort, both from the firms involved and from ourselves. And then to answer your question about optimism, I think the insurance sector has come pretty well both through the pandemic and the previous financial crisis. So I think there are lots of reasons to be positive, and I think some of those challenges in building back better and in managing climate change, the sector has a large role to play, which is not the same as saying it's easy. But we look forward to working with colleagues in Europe and over in the Atlantic to play our part in making sure that the sector can play its role in those broader questions safely.
Thank you, Anna. Birgit, same questions to you.
So thank you very much. Also, thank you for inviting me to this panel. And the previous speakers already mentioned also the topics that also FINMA identified as major risks, like the low interest rate environment that we are now in Switzerland since 2011. Even when there are at the moment some signs of maybe a little bit rising rates, but nevertheless that the interest rates stay very low, and which is, yeah, as already also mentioned, a special challenge for life insurers. We also see have a focus on this rapid pace of the digitalization and the cyber risks that are increasing in parallel. Especially also during the lockdown in particular, cyber attacks became much more frequent and also more intensive. Other long-term risks also identified by FINMA are the demographic aging. And then, as the others also mentioned, the risks, financial risks, of course, arising from the climate change. And something that may be more special for Switzerland is we do see a risk for correction on the real estate market. Maybe if you've seen some charts during COVID-19 all around the world, the prices on the real estate markets were going down, except in Switzerland, they went even up. So we do, or most of the many people have the opinion that the real estate market in Switzerland is overheated and that maybe some correction could come, and this could have then in the insurance sector, but then of course also in the banking sector. And here also comes this, when one sector is affected, maybe then it affects also the other one, financial, the financial parties. So there we also see this connection between insurers and banks. So our supervisory focus and priorities are then driven by the risks just mentioned. When I come to real estate, for example, FINMA will again conduct stress tests to obtain in-depth knowledge about the influence that real estate held in insurers' portfolios may have on company solvency, and if there could also be some consequences for banks. We will, of course, seek to ensure that the financial system remains robust, also in the light of the forthcoming structural changes coming from digitalization and big data, which was also already mentioned. So the increasing possibilities to deal with this, with extensive data collections, and to see that the clients are able actually to benefit from all new opportunities coming with this, with the availability of all this data, but that they are then not exposed to additional risks. Well, staying a little bit with this big data, we see also in the strategy of FINMA possibilities to, of course, also benefit from these data possibilities, so that also FINMA as the authority can benefit from having much more data, to be having the tools and the know-how how to analyze them, so that our supervision will be more data-based in the future, and that we can also actually benefit from this development. And what we also see that in the future, or to overcome all these challenges we have, is of course the international cooperation. For us, as a small country in the middle of Europe, but with some important companies being some bigger players in the whole world, the international cooperation with the UK, with Europe, and of course also with the US is very important for us, and also that the harmonized or a certain harmonized supervision is then helps us, is more efficient for, we think, for the supervisors, and of course also for the bigger international companies. And the question about being optimistic, I mean, as my previous readers that they mentioned, the insurance market or also the financial market actually was quite resilient with the COVID-19 event, and so we are also optimistic also on the economy, that maybe the economy will not go down as much as maybe the expectation was a year ago. In Switzerland, we just had some reports that companies, not insurance companies, but the industry in general is looking again for a lot of people, specialized people, and that it actually that they have troubles actually to get all the specialized people in order to fulfill the work they expect they will have now, starting in the second half year of 21.
Thank you, Birgit. Let's come right back to you on the next issue, and you actually did describe it as digitalization. The EU's new digital finance strategy's stated aim is to facilitate digital innovation in the interest of consumers and market efficiency by alleviating fragmentation and enhancing cross-border coordination. It's my understanding that the Digital Operational Resilience Act is designed to consolidate information and communication technology risk requirements across financial entities. Could you provide some information on how the operational resilience in the financial services sector, including third-party management and outsourcing, is being addressed in your country of Switzerland?
Yeah, sure. So thank you. So the risks related to operational resilience, as well as the risks related to outsourcing and ICT, here we consider them as operational risks. And FINMA has several supervisory instruments in place in order to address the management of operational risks. For example, on the operational resilience, which includes outsourcing and ICT, such instruments would be that insurance companies have the duty to report on operational losses. So they have to collect them in a database, and they have to report them then once a year to FINMA. And they also have to actually report near misses, and of course also to report what were the measures they took in order to prevent such losses in the future. They have also to report cyber attacks, and again also the measures that the companies take in order to mitigate similar attacks in the future. Then on the outsourcing relationship in Switzerland, they have to be approved by FINMA. And then we have also self-assessment a year, or every other year they have to do a self-assessment on the internal control system. Of course, the business continuity management is also reviewed by FINMA or then by the statutory auditors. Maybe also one point on outsourcing, we have this also set up in a circular. And it's clear that even if they outsource some areas, that the company continues to be responsible toward FINMA for all the outsourced business area. When it comes to to new business models and new technologies, we actually, in Switzerland, we really tried to follow a technological neutral approach. So also in the legislations, and so that there's no benefit nor a disadvantage for old or new business models. And we do support all this innovation, and that we try to also take a pragmatic and forward-looking approach so that innovative business models and products also have a chance in the market. Having said that, we also really check that there are no regulatory gaps, then, so that the whole or digital models or with models based on new technological developments would then get some regulatory benefits, and yeah, we would have some gaps there. And last but not least, of course, we do also the operational resilience is always addressed also in the on-site reviews, which during the COVID year, of course, had to be on a remote basis, which was also a new experience actually that we could have here.
Thank you, Birgit. Let's move to onto artificial intelligence. The European Commission recently published a new framework to regulate the use of AI across the bloc's 27 member states. Also, IOPA's expert group on digital ethics and insurance is developing principles regarding AI governance. Frank, how did BaFin approach this topic, and what do you expect? What does the regulator expect from firms in the area? Also related to that is, what do you see as next steps?
Yeah, I think for supervisors, regulators, we are facing always new challenges, and AI is one of these new challenges. And in order to get a better understanding what's going on in the market, we already launched in 2018 or prepared a report which is called Big Data Meets Artificial Intelligence: Challenges and Implications for Supervision and Regulation of Financial Services. And in order to engage in discussions with the industry, with all stakeholders, there was a wide consultation process. And that was very much welcomed by the market, I understand. And based on this report and on the insights we gained via the consultation process, BaFin has since then worked on detailing various questions in the field of AI. Our overarching aim is clear. It's to be prepared for the far-reaching and diverse effects of AI on the financial market and day-to-day supervisory process. As next step, and that is coming in a couple of days or weeks, we will publish general principles for the use of AI in decision-making processes at financial entities. These principles constitute preliminary ideas for minimum supervisory requirements relating to the use of AI and form the basis for discussions with various stakeholders, including, you mentioned IOPA, IOPA's consultative expert group. And at the same time, these principles can already serve as guidance for the entities under BaFin's supervision. As mentioned, it will be published in the next couple of years. Whether AI algorithms yield usable results depends on how supervised entities incorporate these algorithms into decision-making processes. And an algorithm that is suitable for a particular context may yield unusable results in other situations. And furthermore, the algorithms depend on the data which are available and the quality of such data, which is, I think, very important. And this is why BaFin supervision focuses on the algorithms, database decision-making process as a whole, from the data source to the data warehouse and its use and processes. And normally we do not, or generally, we do not grant pre-approval for algorithm based decision-making process per se. Instead, BaFin examines and raises objections to such processes in a risk-oriented manner and where needed. For example, within the context of authorization procedure of new businesses, ongoing supervision, or the supervision of violations of statutory provisions. In justified exceptional cases such as internal models used by banks and insurers to determine their regulatory capital requirements, BaFin examines whether the algorithmic processes that are used are appropriate in terms of methodology, calibration, and validation, among other things. To summarize, we expect from firms under our supervision to implement and use AI carefully and while safeguarding the best interest of policyholders. In addition, we are in a time of rapid change. Therefore, it's crucial that firms keep themselves informed about relevant publications and legislative changes in this field. BaFin's principle will be a necessary and important milestone to clarify supervisory objectives in a transparent manner. Thank you.
Thank you, Frank. Focusing now on an IAIS priority project within the holistic framework of the IAIS, the analysis and treatment of sector-wide and systemic risks are becoming increasingly important. Birgit, how is Switzerland identifying such risks, and do you see a sector-wide or systemic risk building up in the insurance sector? And how does FINMA address these risks?
Yeah, thank you. In Switzerland, we actually did a complex and thorough analysis. So FINMA has developed a process by which existing or emerging risks can be analyzed with respect to their systemic or sector-wide relevance for the Swiss market. The goal is actually to prospectively identify potential risks and to counter their development before they could realize as sector-wide or even as systemic risks. And the process we now apply the first time takes up the framework of the IAIS and then considers also the EIOPA approach and concretize it for the Swiss insurance market and for our supervision. We collected first top risks and scenarios, including the ones from ORSA, and then combined this with FINMA expertise from various resources. And FINMA also translates then these scenarios or building blocks for scenarios in a representation we specifically tailored to potential sector-wide or systemic risks. And then at the end, we assess the resulting scenarios, which are candidates for potential sector-wide or even systemic risks, either by bottom-up or also by top-down or bottom-up stress tests. What we could find is that in Switzerland, we do see some, on the one hand, more for the insurance sector, some sector-wide risks, which we do address already some years ago. One thing is what we see is that in the evaluation of the insurance liabilities for solvency purposes, the use of too optimistic interest rates. We think this was not just addressed by us, but also the European Systemic Risk Board in 2017 pointed out some potential systemic implication from the use of interest rates in the solvency calculation. In Switzerland, we addressed this also in 2018. And we do try to get a more realistic interest or yield curve when it's which is used actually for the calculation of the liabilities, especially, of course, the long-term liabilities. What we see more as a which could develop to a systemic risk is something I mentioned before, is the real estate market in Switzerland. And because in recent years, several large Swiss insurance companies have increased their investments in the real estate and mortgages. And this volume could exceed the critical level if the hard eligibility limits for tied assets that we have is to be removed, which could be because we do have a new supervision act, Insurance Supervision Act, which will then use more the European approach of prudent person principle, and their limits we have today implemented for investments in different asset classes could be eliminated, which then, of course, due to the low interest rate environment and the run for higher returns drives then people into the real estates. And there we do see that in a severe recession, that real estates in Switzerland could come under a substantial pressure, which then could affect actually the whole financial market and not just the insurance industry.
Thank you. Anna, in relations to the implications of Brexit, some members of Britain's parliament have called for a formal objective to keep banking and insurance sectors globally competitive after Brexit. Do you believe that an actual competitiveness objective is warranted? And can you comment on whether any specific changes are necessary to ensure that the UK remains open to new business, whether from advanced economies or emerging markets?
Indeed, a number of parliamentarians have been arguing for an objective, and certainly the insurance industry has very explicitly argued for us to have a competitiveness objective. I think ultimately it is obviously a matter for Parliament, so we will do whatever we're told to do. But I think we are arguing for something that's actually a little bit more of a middle ground. I think where we are post-Brexit is that a number of the decisions that used to be taken at political level between the UK government and the European Commission and obviously the other nation-state governments will now be passed down to us as a regulator. And I think it's reasonable that where we are taking decisions that previously would have been taken by the politicians, that it's reasonable for the government to ask us to have consideration for some of the things that they would have had consideration for previously. So where we are today is that the Parliament has just agreed for the implementation on the banking side of the Basel 3.1 regulations that the PRA should have regard to competitiveness, but that not be an overriding objective on the same level as safety and soundness or financial stability. And we think that strikes the right balance between needing to be sensitive to the knock-on implications of and the costs of regulation, but not risking some of the downsides that come if too much focus were to be on competition. For example, the temptation to constantly dilute regulatory standards, which we obviously don't think is sensible. We think it's that positioning it as a have regards, as indeed we do for have regards for proportionality, have regards for international standards, have regards for the impact on economic growth, feels to be the right level. We, to respond to the second part of the question about the extent to which we need to change to continue to be open. I mean, the UK philosophy, such as it is absolutely about open markets, and we think that risk pooling cross border is in the interests of the firms, the economies, and the consumers, and that's a really important part of our approach. And working with overseas, with other global regulators to do that on individual firms, plus and as well as international standards and sector-wide risks, is a really important part of our approach, and one that we'll need to work even harder at post-Brexit, because we don't have the natural, as some of the natural fora that we did before. I mean, it's worth pointing out that the London market, the sort of so-called London market, is actually 85% part of global groups that are not UK headquarters. So it really is at the heart and the centre of what we do. We are looking at our processes to make sure that, in particular, in terms of access for new capital, either to increase risks as, for example, rates harden in the wholesale market, that we can that firms are able to do that in a proportionate and appropriately timed way, but without compromising on the prudential standards. And we think there may be some changes that we could make. We've also introduced a protection for UK retail business, where the failure of reasonably sized firms could have an impact on our own compensation scheme. We would expect greater levels of supervisory control for the PRA, but that's a very specific set of controls to allow us to have more involvement in those firms. But the base principle of the way that we operate is to work where we can, sharing information where we can across borders to as efficiently as possible regulate these sectors and let them provide as much support to the economy as possible in the safest way possible. Thanks.
Yeah, thank you, Anna. First of all, the information you're providing, thank you to all of our panelists, very insightful. And we are trying to cover a large amount of ground here, but very much appreciate those thoughts, Anna. I think, although there are many of us who would like to hear more about Solvency II and the application, I think I'm going to move forward to a question about infrastructure. So this is related, but really I want to pose this question to all of you to give us some perspective of where you are in your country. The G20 recognizes the importance of infrastructure for growth and development, and the need to tackle investment shortfalls as a way of lifting growth, job creation, productivity. You know, we've heard comments about real estate and what that can do. We all know that in this environment, institutional investors are constantly searching for stable opportunities that can match the long-term liabilities. It's been argued that in that context, infrastructure assets can be particularly attractive due to their time horizons and relatively high expected yields, thereby providing opportunities for portfolio diversification. However, as supervisors, we have heard that there are potential impediments, such as regulatory and procedural impediments in the insurance industry from being more active in this asset class. From your perspective in your jurisdiction, do you believe that the regulatory treatment of infrastructure assets is an impediment for insurers to invest in them? And if so, should the regulatory treatment of infrastructure investments be different? Let's start with Birgit and then go with Frank and Anna.
Thank you very much. Actually, it's interesting. We always hear this as well from the insurance company. And nevertheless, we have to say in Switzerland, we do not believe that our current regulatory treatment of infrastructure asset in Switzerland is an impediment for insurance to invest in them. Because there are many possibilities to do this. And I mentioned some quantitative limits we have in order to consider such investments as in the category of tied assets. But when we look at how much of the investments are actually in infrastructure, these limits are still much higher than actually the insurance companies have, and maybe it's for Switzerland it's driven that we don't have so many infrastructure projects an insurance company could invest in, because the big infrastructure projects are from the government, and so no private investment is necessary, and if they would go into other countries, there is always the issue hedging the foreign currency, and so as said in Switzerland, we often hear this that there are some obstacles in order to invest. Looking at the legislation and the regulatory environment, they could invest more than what they do today in Switzerland.
Yeah, I pretty much agree. Even if we do not have limits, we have the prudent person principle, and companies are able to invest in infrastructure, but there is a lack of attractive infrastructure projects with attractive yields for the companies. I think that is the main issue. There are under Solvency II some regulations that companies can benefit from a lower capital requirements if they are fulfilling a certain set of mainly qualitative criteria. I think that's an appropriate, acceptable regulatory approach. But let's keep in mind Solvency II is a risk-based regime, and we need to make sure that risks are reflected appropriately. And for me, infrastructure investments are not per se less riskier than other investments. So a flat rate capital relief is, I think, not justifiable for me. Any calibration of risk for any class of investments should be based on evidence, and that is one of the principles of our regime. But in addition to what Birgit just said, I think with regard to investment strategies, the regulatory treatment of an asset class such as infrastructure may not be the main driver for insurers to invest. Other drivers, and there are studies about that, other drivers like risk return profile, accounting principles, asset liability management, liquidity management, and so forth, I think they are much more important. And I think that we do not see sufficient investments in infrastructure. That is not the fault of our supervisory regime.
Anna, any additional thoughts?
I would largely agree with what Frank and Birgit has said. And I think where we see the insurers in the UK investing using the framework that Frank mentioned, where you get a benefit for being a buy-to-hold investor. Actually, most of the investment that they have been looking to do has been in real estate, whether that's individual housing or commercial real estate, rather than infrastructure to date. So I think sometimes the industry is tempted to use it as a lobbying tactic on capital requirements more generally. Having said that, the one thing I would say that I think we are certainly thinking about is where infrastructure projects are innovative, as they might, those targeted at climate change might kind of by definition need to be. Are there ways that we can think about to assess what the risk will be, which aren't based on sort of historic data, because the historic data doesn't exist. And equally, the converse, that just because historic data suggests one thing, that, as Frank says, it should be risk-based. So actually, if climate means that the historic data on a certain asset class is actually underselling the risk, then we should reflect that too.
All right, thank you. Our closing question for all of you will be in relation to supervisory cooperation. Do you see any changes in international supervisory cooperation due to COVID-19? And what do you see as the main opportunities and challenges for home and host supervisors of internationally active insurance groups in a post-COVID-19 world acting under different supervisory regulations? Related to that is, how can we further evolve and enhance supervisory cooperation, leveraging our experiences and increase reliance on digital and remote technology? Let's start with Anna, and then Birgit and Frank. Anna?
Thanks. I guess I would start by saying that our approach to international cooperation is, in the first instance, influenced by the change from Brexit and the need for us to make even more commitment and effort to that form of cooperation in the international fora, but using other opportunities that we see, including events like this, and we are very much appreciative of that. I think COVID has highlighted how we are able to communicate well across borders in crisis. We had a number of conversations, even though we were no longer in the European Forum, with Frank and others, about the risks that we were seeing, both on individual firms, but in parts of the sector, and also then on the new risks that, or the emerging risks that COVID is accelerating. And I'd just like to make a quick plug for the Sustainable Insurance Forum, which is obviously one of the main areas in which insurance regulators are coming together to share experience, share knowledge, share ways that they are trying to supervise and regulate for the risk that climate change is bringing, and move the industry on in their sector. And I think that this is more about opportunity, and COVID has sort of increased and accelerated some of those, but not necessarily changed it. Thanks.
So for us, I think COVID-19, when it comes to international cooperation, there was some, in a way, a driver for a radical change, especially because all the meetings and the interaction now was done on a virtual basis, and actually for us it proved to be very practical to frequently engage with foreign supervisors, and it allowed for more frequent cooperation, and to also instead of having calls, when we had, let's say, virtual cooperation, we always had calls before then when we just had maybe one topic to exchange. Now the video conference became more the usual tool also for bilateral interactions. And of course, looking also forward, I think in general, then also travel budget restrictions are probably in the future not really excuse anymore in order to not participate in a meeting, because there are now the hybrid model of meetings probably will be used more frequently. And so we do see at FINMA opportunities to engage more with foreign supervisors. Also, we had this remote on-site reviews where we now see that there is the possibility to invite also foreign supervisor on-site reviews done then with remote tools. And so this instrument can be used also after COVID, probably more frequently. And this, I think, and we see that the cooperation can be enhanced based on the experience we could make or still make now also with this panel actually. With COVID-19, and yeah, of course, I'm coming back to the Sustainable Insurance Forum that Anna leads. Of course, for the climate, it's also better when we have actually all our meetings in a virtual forum than if we would have flown over to the US, all the three of us today or yesterday, and then back again. So we think the experience was good, and we can take a lot of good things out of it. Maybe not so much the home office restrictions, but a lot of when it comes to the exchange with other foreign supervisors. Thank you.
Frank.
Perhaps I'm a little bit old-fashioned, but I would prefer a meeting from time to time, a real meeting, and important is the time between the sessions in a meeting. And I think you build up a lot of trust when you meet personally. That is my personal opinion, but I agree, cooperation works fairly well. I think that's good, but in the longer term, we have to be honest, good video conferencing systems will not be enough. I think we have to have better technical solution. We need minimum technical standards, for example, for information exchange, including rules as confidentiality is concerned. And we need some minimum rules, how we collaborate across time zones. For example, in the IAS, that is not so easy. And I think the state of the art and workflow processes and data analysis must be taken into consideration in order to bring the risk orientation of supervision more clearly into our focus. But having said that, I think further convergence is still a journey, and we are working together in which format ever on global regimes such as ComFrame, and which ultimately will also include an ICS, hopefully, for measuring capital adequacy. And along this journey, we will have to make sure to take all regions on board. And as I repeat, I think preferably we should meet in person very soon. Thank you very much.
Thank you, Frank. This has been a fantastic panel, and appreciate all those comments. Akram, do we have any questions for our panelists that we could take up in the minutes that remain?
Absolutely. Thank you, Commissioner. Yes, we actually have a number of questions. So one question for all of the panelists. We've seen an increase in cyber attacks against insurance companies in the US, including debilitating ransomware attacks. How is Europe dealing with cybersecurity? And is it being done on a sector-specific manner, or is it being handled on a cross-sectoral basis? Who'd want to respond to that?
I don't know what should be the cross-sectoral basis. I think the big challenges of cyber risks up to now, they cannot be insured, I think. There are certain limits, and if I see the markets right or correctly, limits are even reduced during the last 2 years or 3 years. The appetite a couple of years ago was much bigger from insurance companies, but now they see you cannot really insure to a substantial limit this risk. And I think for me, it's very much comparable with the pandemic. You know, you cannot as a private sector really cover all the relevant risk there. So I'm personally very skeptical. And for me, cyber insurance is not a cash cow for insurance business for the future.
So I tend to agree with Frank on the underwriting side. On the operational resilience side for the insurers themselves, we've also seen the increase in level of attacks. We've asked all the firms that we regulate to come up with their own level of a sort of a risk appetite, as you were, for the systems being inaccessible because of this kind of an attack, and we've asked them to do that by the end of the year, and we will look to challenge whether the defensive systems are sufficient to be able to manage that. We also require firms to carry out a number of sort of external penetration tests to help them, certainly the larger firms, to help them identify potential weaknesses, both for external attack and for internal attack. But it's a fight, it's a fight that ratchets up every time the firms do something to improve their resilience. The attackers are incentivized to be able to do more. So it's certainly a big challenge.
And maybe also to take up on this at FINMA itself, we also increased our own expertise on cyber issues in order to challenge also the companies on their cyber issues, and that they address these risks. We do on-site visits in order to check the infrastructure against cyber attacks, and as Anna also said, also for bigger institutions, we also accompany them when it's to simulate actually with external companies such cyber attacks, in order also to see how the companies can react, and on the other hand, of course, that they then can also see where they are still vulnerable and where they have to fix their systems. So yeah, cyber risks and cyber attacks are also risks that also FINMA focus on, and is trying together with the institutions, of course, to make them more and more resilient against such cyber attacks. Thank you.
Thank you.
Great, Akram. Do we have time for one more question?
So I think we've got time for a very quick question. Just if anybody wants to respond. Just mentioned operational resilience, and I think COVID has highlighted the importance of this. What are your authorities doing in this area more generally, and working to ensure that businesses' continuity plans are up to date?
Yeah, I misunderstood probably the first question. I answered on the underwriting side, but I could echo what my colleague said about our supervisory approach we are challenging companies. We are expecting that they make major investments. And I think for me, it's clear they have to improve dramatically because the elder systems in the companies, I think there's really a challenge for this type of attacks.
The only thing I would just have quick. Oh, sorry, Birgit, go ahead.
Oh, thank you. Maybe on your second question, business continuity management in Switzerland, this is reviewed regularly, by either by FINMA or by statutory auditors. I think that COVID-19 showed where a company is vulnerable, and operational resilience is not so much given. But we have seen that most of the, especially bigger companies, have quite good infrastructure. Where we've seen issues are more smaller companies or traditionally leaded companies. They showed much more problem with the continuity of the business with COVID-19, and of course they have now more homework to do, and this is followed up also by the supervisor.
All right, thank you. This is going to conclude our Q&A, as well as our panel. And again, let me thank you both, all Anna, Birgit, and Frank, for having joined us for today's panel. I know I have thoroughly enjoyed the discussion and greatly appreciate your insights and your flexibility in participating. As we have discussed, this has been a big year for Europe, and next year promises to be just as pivotal. Hopefully next year we do hope to be back together, to have the opportunity to meet at the NAIC International Forum together in Washington, D.C. There will now be a short break, but we will be returning for the fireside chat with IAIS Secretary General Jonathan Dixon and EXCO Chair Victoria Saporta. So thank you very much. Again, appreciate all the hard work that went into this panel.
Thank you. Goodbye.
Bye. Thank you very much.
Thanks,
Bye.
Thank you very much. Bye-bye.